Hi, this is Professor Cataldo, and I'm going to walk you through the very basics of the different components in the journal entries for the different inventory accounting methods. So I'm going to focus very narrowly just on the components of the journal entries associated with measures that change depending on the cost flow assumption. And in doing so, I'm going to use a single fact pattern. This is the fact pattern. This single fact pattern is going to be used for specific identification, first in, first out, last in, first out, and weighted average methods of inventory. These are all US GAAP methods, and they are different cost flow assumptions. But this fact pattern does not change. So on August 1, I have beginning inventory of 910. That's not going to change. On August 3rd, I purchase some inventory. On August 14th, I sell some inventory. On August 17th, I purchase some more. On August 28th, I purchase some more. And on August 31st, I sell some more. So this fact pattern is used for all four cost flow assumptions: specific identification, FIFO, LIFO, and weighted average. Now, I wanted to capture the journal entries for these transactions on a single PowerPoint slide, and I've labeled them: specific identification, FIFO or first in, first out, LIFO or last in, first out, and the weighted average method. And the reason I did this is I want to show you what does change and what does not change, and I think it's going to make sense. If I can identify the journal entries that do not change under any of the four methods of cost flow assumption, then I only have to learn those journal entries one time. And then I can focus on the differences. So, for example, August 3rd, there's a purchase of merchandise inventory on account 1590. Well, that's not going to change under any of the cost flow assumptions. On August 14th, there's a sale at 2600 on account. That's not going to change under any of the cost flow assumptions. Same with the August 17th purchase of merchandise inventory on account at 2300. No change. Same with the August 28th purchase of merchandise inventory on account. No change at 1190. The same with the sale on August 31st. Those sales were on account. No change at 3450. So when you're studying this material, the first step is to understand what does not change, and then we will build on that foundation by focusing on what does change. So it doesn't matter what the cost flow assumption is. You paid what you paid for the inventory, and you sold it for what you sold it for. That does not change. So that's the black type. Nothing changes. Focus only now on the red, the items that do change. And the items that change always involve two accounts. One is an income statement account, cost of goods sold, and the other is a balance sheet account, inventory in the assets section, merchandise inventory. That's the only thing that changes under the four different cost flow assumptions. I'm going to go to the next slide. So, the only thing that changes under the different cost flow assumptions is the allocation between a balance sheet account called ending inventory and an income statement account called cost of goods sold. And I've placed this in the framework that you're very comfortable with, probably, at this point in time. If I take my beginning inventory, I add net purchases. That's going to equal merchandise available for sale. And I'm going to allocate that merchandise available for sale during the period to my balance sheet and my income statement, depending on the different cost flow assumptions. Of course, specific identification, they're going to tell me which items were sold. Specific identifications used for big ticket items, things like automobile sales. an automobile retailer. Under the first in, first out assumption, I am going to assume the first items purchased are the first items sold. That's a cost flow assumption. Under LIFO, last in, first out, I'm going to assume that the most recent purchases are the first items sold. That's a cost flow assumption. Under the weighted average method, I'm going to be computing the average cost per unit at each reference point of sale, the time when I make a sale. So, all I am doing is allocating merchandise available for sale between my balance sheet and my income statement. That's it. Cost flow assumption. These costs flow in a particular or specific sequence. Thank you.